So welcome to another Franchise Company First Friday group. I'm Nick Bramley. I'm your host for the day. I'm your host because normal host Julie is traveling and she's in Edinburgh at the moment. So she passed on her apologies, but is looking forward to a fantastic session. For those who are not aware, it's not really the first Friday of October. And the reason for that is last Friday, there were two big franchise exhibitions, one in London and one in Birmingham. And we thought we don't want to clash with those and see the numbers crash in terms of our normal attendance. So that's where we are with that. I would like to say a special welcome to our guest today, Paul Hansen. Paul's from Hitachi Capital Franchise Finance. And Paul is an expert in lending and taking the risk out of your attitude to money. We normally have two speakers for the First Friday sessions, but we are giving Paul the floor for the whole of the day. So without much further ado, it's over to Paul Hansen from Hitachi Capital Franchise Finance.
Right, brilliant. So for those of you who don't know me, I'm the sales manager for Hitachi Capital Franchise Finance. For the next hour, really, we'll just talk through some of the funding options available to people and sort of the nuances about funding. But I'll go through a little bit of background about us as a business as well. But I kind of thought I'd like to just set the scene because, as Mark's already said, I'm already old, or feel old anyway, and having just done the franchise show and realized how many youngsters there are in our industry now, which is great, it made me feel even older. But I wanted to kind of set the scene a little bit about the background, my background in lending, because the aim of today is to talk about business borrowing and don't fear finance, because most people seem to have this real aversion to debt. And if I go back to the start for me, I did as well. So I've got a little bit of a story that I just kind of like to tell to try and give you a background to how I ended up doing what I do. So if I go back to the very start, I'm the grandson of a shipyard worker from Sunderland, so good old northeast, and a savings bank manager from a small village in Norway. So as you can imagine, they both had very different, you would have thought they'd have both had very different views on debt, i.e. the bank manager who basically was lending money the whole time versus my shipyard worker grandfather who basically had no money at all times. But other than a mortgage, they both had a firm belief at that time that if you couldn't afford it, you didn't have it. So you would save and save and save until you got the money to be able to go and afford what you wanted to buy. So having that background, it was instilled in me through my parents as well. So up until the point that I left school at 18, that's kind of how I'd been. So how did I end up now promoting debt and lending millions of pounds to businesses for the last 30 years? Well, when I was 18, I decided I was going to take a year out between university, and I took a job, believe it or not, selling cars. Well, I actually worked for a contract hire company that was selling courtesy cars into the body shop arena. So if you imagine when you take your car in, you get that little small Citroen AX courtesy car. I'm going back a few years. So they cost £4,500 each, those cars. And at the time, I was a newbie and I was working with the managing director about how to structure this deal. So we negotiated a volume bonus with Citroen based on us buying 1,000 cars a year. And by doing that, they agreed to drop the price to £3,000 per car. Can you imagine buying a car for £3,000 now? It does make you feel really old. So anyhow, we rented those cars out to body shops for £100 a month. And Citroen guaranteed to buy them back from us at the end of that 12-month period for £3,250. So I rent them out and I get back more than I paid for the car. Quid's in, right? But I didn't have £3 million worth of cash to go and buy all of the cars. So we had to borrow that. So can anybody get any ideas of where I might have gone to borrow the money? It wasn't the bank. We went to Citroen Finance and said, we want to buy £3 million worth of your cars. Can you lend us some money to buy £3 million worth of your cars? So they lent us £3 million to buy £3 million worth of cars. At the end of that agreement, I had to pay a bullet payment for the borrowing of that money, which was £250. So I basically bought £3 million worth of cars from Citroën, agreed to sell them back to Citroën for £3.25 million, and Citroën were going to lend me the money to do it. So all the way through that process, I could do absolutely nothing with those cars, and I wouldn't have lost a penny. But if I got somebody to rent those cars from me for £100 a month, that £1,200 a year was effectively margin for us. So that delivered us over £1.4 million in profit. Now, had I only had enough money to buy 2 or 3 cars, I would never have been able to attract that level of income from the business. So it was that point that I realized how important planning and understanding and structuring deals, and why debt could be a good thing for your business. Not always, but could be a good thing for a business. So I just like to give that little bit of a background to how I ended up in finance, and that's where I started my career. So I did that for 2 or 3 years before moving on and becoming a director and shareholder of a brokerage business that took residual risks and value. So I had everything from wheelie bins to police helicopters on my portfolio. And then I've ultimately ended up working in the franchise industry sort of 20 years ago, supporting typically retail companies that were looking to fund their businesses. So the aim for today is to really go through and talk about what we can do to help in terms of the borrowing side of things for you. So we'll talk about a couple of options that are available to you. So the first thing I've highlighted on here is the QFP aspect. For those of you who don't know, that stands for Qualified Franchise Professional. So that's an accreditation that we get from the BFA. I'm hoping you can hear and see this, because I can't see anything now other than my screen. So so the QFP stands for Qualified Franchise Professional. I took that qualification 3 years ago. We as a business train people in that qualification, but it's important to us and for you as prospective franchisees or franchisors to think about whether that would add value to your business. It's basically the kite mark that says that you've thought about it, been trained in it, and make sure that you're going to run a really ethical franchise business. So to give you some background about us as a business, so Hitachi Capital Franchise Finance was born out of a business that was a private business called Franchise Finance. It was acquired 4 years ago, just under 4 years ago, which is when I joined the business. I joined the business to help facilitate the sale. And Hitachi at the time were one of our biggest non-bank lenders. Mark, at his time at NatWest, was one of our biggest bank lenders. And franchise finance was a sort of a pivotal point. We were either needed to get some investment into us to grow, so private equity type funding to grow, or we needed to be acquired. We looked at both options, and we had lots of interested parties. And based on the structure that we put together, Hitachi had become our biggest lender, and therefore we would be particularly attractive to them. So we were acquired, and we're now in a really unique position, because most of the time when you're acquired by a lender, you can only lend their funds. Our business model focuses around 3 key things. We do business planning. So by doing that, we create a business plan template, which enables a franchisee to then understand what they're expected to achieve during their franchise term. But also it shows what cash, what funding, what lending they're going to need, and what profit they're going to get out of it. So they use that business plan to secure the funding that they need to fulfill their objective. But obviously, we've also got people that are coming into the industry that may be, I don't know, teachers, firemen, firewomen, anything, white collar workers, line management, but they may never have run a business before, and they're going to come into the franchise arena and they're going to start the need to run a business. So we also have a training academy that teaches people the basics about running their business. And at the same time, we then have something for franchisors, which helps them grow their business. So if you've got a network of franchisees, we can coach and guide those franchisees to go from being maybe a man in van or woman in van operator to a management style operator, and how do we grow that process. So we have 3 distinctive parts. None of our customers have to take all of them, but most of them take all of them at some point, because as you go through your franchising journey, you need different things. So Hitachi acquired us, and we are in that unique position of being a lender as well as a broker. So my team don't have any driver to lend Hitachi funds. They have a driver to lend to a customer based on what is the best solution for the customer. And that solution might be based on price, might be based on personal preference of which lender to go to. It might be based on security, or it might be based on speed. But effectively what we do is talk to a franchisee to understand what their needs are, and then we discuss what options they have based on our lending panel. And we give those options to the franchisee, and we guide them about what the different products are, termination rights are, costs are, timings are, and we guide them through that process. But they'll ultimately decide which one they go for. So I think that's a really unique position to be in as a lender, not to be targeting my team to sell Hitachi funds. So going back to what I was just saying about Mark when he was at NatWest, we would refer deals to Mark at NatWest because Mark had a product that may be a secured lend that was the best product for the customer. So it's those kind of things that we do. So that gives you an idea of what we do for our customers. There is a franchise life cycle, and we support everybody at every step of that junction. We deal with over 150 brands. So we've already talked about the business plan and the finance, but we also provide that financial training and then the health checks. So when there are some brands that maybe have 10% of their network that aren't performing, you've tried everything, maybe that external set of eyes coming in and talking to people, looking at what they do from a overview point of view, and putting together a health check program to turn around and say, this is your time bound scope of what you need to do. So we help them do that. Now that really does help bring up those bottom 10%, but it can also be worked through those middle 60 to 70% to turn around and say, well, okay, how do you become the best? And what do you need to do differently? And we can come in and help and coach and guide. We help with the assistance of expansion, whether that be through acquiring new territories. And we do that through either putting together a business plan to help you, or with the securing of the funding for them. And then obviously we all need to have an end goal. Now, actually, we talk to people about what their end goal is right the way from the outset. What are your goals and objectives? What are the personal goals you have? I.e., that might be to send my daughter to medical school. Well, actually, it's going to cost you a lot of money to send your daughter to medical school potentially. So your business goal could be to generate an extra £20,000 a year profit to cover the costs of sending my children to med school. So we link the two together. And then ultimately we want to know what your end goal is. Do you want to be in this for 5 years, 10 years, or what's your exit strategy? So we can plan around it. So you're probably guessing that we talk about planning quite a lot. So with the planning and the training side of things, we have a training centre based at our head office in Staines. But we use this slide really to talk about the awards that we've won. So we've won the Best Franchise Awards 2 years back to back. And we also won 2 of the 3 affiliate awards that you can win at the last awards that were done in 2019. They weren't done last year, but we won the Customer Service and Team of the Year award. So we kind of think we're pretty good at what we do. The feedback we get from our customers is pretty positive, and also from the lenders that we work with, they also value everything that we do as well. So borrowing money, so the aim of today, really, where's the best place to start? So before you can think about borrowing money, you really need to think about, what do we think about as a lender? And I talked about a lender being me, but it's also our whole panel, because most lenders work in very similar ways. So you need to think about what they're going to want to see and what they want to go and hear. But you've also got to put yourself into the mindset of being a lender. And it's a very dark place. I'm the head of sales and marketing, and so I'm quite a positive, fluffy guy. But our lending guys really are the most pessimistic people in the world sometimes. They're always looking at that worst thing. So credit guys always look at the worst. So we want to make sure that they understand that and can evaluate it and make sure that they make the decision. So if you put yourself into that worst case scenario, pessimistic, then think about what you can do to help them. So there used to be the 3 R's. I'm old enough to know that they were reading, writing, and arithmetic, which never did actually start with an R. But our credit guys and our lending guys are obviously much more intelligent. So they do have 3 things that do begin with the letter R. So they have risk, reward, and repayment. So whenever we look at an opportunity, we're looking to see how risky that opportunity is. Is it a brand new start business, or is it a brand new start franchise? So if it's a new start franchise following a proven model, that's less risky than somebody like Paul just opening up his coffee shop. So the risks are evaluated. We then look at the reward element. What are we going to get paid as a lender for taking that risk, and when are we going to get it paid to us? The final part of that is the repayment. So that's the hope element. We are hoping that you are going to repay us at some point. And if we've done the risk and the reward bit right, then hopefully you'll repay us on time and as we expect. So about lenders. As any other business, we've got profit and loss balance sheets, targets and ratios to maintain. We tend to have shareholders, but we've also got regulations as well. So we have to really focus on who we're going to lend to, how we're going to lend. So this is why we say, don't be disheartened if one lender turns you down, because their target may not be to lend to a coffee shop or a gym. And that might be because they've got too much exposure to that area or that sector. So don't be disheartened if somebody declines you on the basis that you are trying to open up a gym. My team here know what all of our lending panel's appetite is. So our aim is to have a conversation with you guys, and we can help you, talk you through the process and let you know which of the lenders will be most suitable for you, to save you having the same conversation 10 times over. So I wanted to give you a bit of an idea about how the lenders look at propositions. So if you imagine that there's a £100,000 franchise, typically what you're going to be looking at is some cash contribution. Now, this varies depending on the strength of the brand that you're looking into and how experienced they are. But in this example, we've used a ratio of 70-30. So as a franchisee, you should always expect to put some cash into a business. As a franchisor, you should always expect your franchisees to have some cash to put into the business. As a lender, we don't like lending 100%. Now, some people do manage to scrape 100% together. Personally, I think that's a very risky strategy because they aren't fully entrenched in the risk of their business. They've got less to lose. And I also think that can put a risk to you as a franchisor, because obviously they could walk away with less financial impact to them. Now that puts your brand at risk, because if they've walked away, as a lender, we lose money. That puts a risk to your brand as to whether we would want to lend to your brand going forward. So it's really important when you go through your franchise recruitment that you focus on what financial position your franchisees have. Any brand we work with, we do what's called a pre-qualification call. Now, in that call, we talk to them about everything from their financial status, credit status, marital status, home ownership, visa status, because what we're trying to do is to gauge a picture of what the franchise looks like, the franchisee looks like. And from that, we start off with our panel of lenders, and we knock lenders off to say at the end of the call, yeah, we think you're good for funding and we've got 3 or 4 options for you, or no, we don't think you're good for funding. We think you need to go and do some things to get into a position where somebody would lend you some money and we'd help them do that. Or actually, yeah, okay, there's some things in your credit profile that aren't great, but actually we think we could get you funding, but your options are a little bit more limited. So in this scenario, we've got a 70-30 risk. As a lender, we're taking 70% of the risk. Over the next sort of 3 years, that franchise might deliver, say, 80k profit for the franchisee. We actually make relatively small margins, so it's based on the fact that we do lots of, which is why we like franchising, right? Because we do lots of franchisees in a proven brand, and that's why the lenders like franchising. But we typically are going to secure, say, £5,000 or £6,000 in profit for lending that 70,000 over the course of the process. So what happens if that goes wrong? So imagine we lost that £70,000 and it was a loan and we didn't have any security, and all of a sudden we've lost it. Well, we've got to do 14 more transactions just to stand still, just to get our £70,000 back. Okay, so that's why when we're looking at these transactions, we are going to be a little bit careful, cautious, sometimes difficult, I suppose, as lenders. This is just across the board, not just Hitachi, because we're going to ask a lot of questions, because what we want to do is to make sure that we are lending responsibly. You guys feel comfortable that you've got the funding that you need, and we feel confident that you've got the business plan, the structure, the financial wherewithal to understand what you're going to do and what risks you're taking to be able to repay that money in time and on time. You've got to remember, if we get this wrong, there are serious consequences, whether they just be financial consequences, but regulatory consequences for us as lenders. We need to make sure that we have done our due diligence to understand that you have the ability to repay. Now, that could be something as simple as, how long is your visa got left on it. And if it's only 2 years and you've got a franchise agreement for 5 years, should you be lending past that 2-year term? Because obviously they may not be able to still be in the country at that point. Or if you've only got a lease on a property that runs out in 3 years, would you be able to continue to pay after that point? So they're things that we would need to consider when we're looking at the application. So there's a picture of my local pub. If you imagine, put yourself into the credit position, it's kind of like being sat at the bar. And the guy suddenly sits there next to you and goes, I've got this great business idea. You've never met them. You know nothing about them. And he pitches his idea to you. So based on that concept, that's how our credit guys feel sometimes. So you sat there and you've listened to that person talk about what their business proposition is, and he wants to borrow £30,000. Would you lend it to him? Would you just say, hey, that works? What would you want to know? So again, this is sort of a game to try and think about what you'd want to know. And I'm not going to make you all try and do this. I normally do this presentation with a live audience, and I normally do it about when you've got husbands and wives sat next to each other, fathers and sons. And it kind of, the look is quite amusing when you see whether they would lend some money. So what we want to do is to try and give you an idea of what we're going to want to know. So the first thing we want to know is how honest and reliable you are. Well, we can do that through fraud checks, criminal records checks, those kind of things. But we want to know that you've got a good track record with money. Now that will come initially from your credit score. Credit score goes back many, many years, so 7 years. We can see whether you've missed payments on mortgages, how much you've paid, what credit card debt you've got. So it's very important that as a franchisee or as a franchisor recruiting franchisees, that you talk to the franchisees about this process, because this is what will determine whether we can lend to them. So it's really important that people look at their credit score, because there might be something in there that they weren't aware of. And the quicker you can fix that, the better. Now, as a franchisee, they can get their own credit score, the basic credit score, and see whether it looks good or bad and what they need to do to fix it. We don't like putting footprints on people, so we don't do the credit scores particularly early on in our process. We also use that for a reason as trust, because we are about to sign up to a 5-year agreement with them potentially, and you might be signing up to a 5 or 10-year agreement with them. And actually, if they haven't disclosed stuff to us that suddenly comes out in their credit profile, that's kind of like the last point of the acid test, where do you really want them in your franchise network? So actually, we encourage them to say, we're not going to do your credit score immediately, but if anything comes up, it will go against you when we're trying to look for the lending. So you need to be open and honest with us. So then we look at things like the business proposition. How risky is it? So if you're looking at a McDonald's, we know it's a proven model. If you're looking at McDougall's, who is a new Scottish brand that we've just decided to work with and we know nothing about, is it going to work? We don't know. Or maybe it could be McDougall's from South Africa or France, and it's worked over there, but they're bringing it to the UK. How's that going to operate in the UK? What's the risk? So you need to tell us how that's going to be there. How and when will the borrowing be repaid? So we look at what the risk is there. Obviously, we like to see a regular monthly payment come through, because obviously it shows that the bank account's still live, there's some money in it, etc. But some people might ask for monthly in arrears or annual in arrears payments, which increases the risk for us, because we don't know how that company's performing necessarily for the first 12 months. So the timings of those things are really important. We like to look at a safety net to cover what happens if it goes wrong. Now, that safety net is not just about our safety net, it's about yours as a franchisee as well. What cash have you got left after you've started your business to cover you for that rainy day fund? If you go back 18 months, when the start of this pandemic, there were some scary stats. The stats were that less than 36% of companies had more than 3 months working capital to cover their business. If you went to, there was something like a stat, like something like 18% had only 1 month's working capital. Now that's a big risk as a lender, and it's a big risk for you as a franchisor as well. So you should be talking to your franchisees about how much cash they have in their business to make sure that they've got enough to cover them for that rainy day fund if it takes longer to start off operating well. We want to know how much we're going to make for our money, because obviously the bigger the risk, the bigger the reward we're going to take. And has the sectors been affected by COVID or even Brexit as well, obviously from the supply chain side of things. Once we've done all of that, we're going to look at the principles of lending. And there's many factors that will balance that out to decide whether we want to say yes or no to an application being approved. But we're going to look at the fundamentals first of all. So honesty, integrity, credit history, they are the absolute basics. We're going to look at that. Has the franchise model been proven as profitable in the UK? Hopefully you can get that data from your franchisor. We will also get that data if it's one of ours, and we update our business plans regularly to make sure that we've got the data to show that what a franchisor is telling a franchisee they should be able to achieve is achievable. There are brands that have never achieved the projections that you can imagine. They're the ones that most of the lenders don't want to lend to, because as we do our due diligence, every time we get every 3 to 6 months we get more data, we go, hang on a minute, this isn't working. So it increases the risk. Does the franchisee have the necessary skills, or will they receive sufficient training? One of the beauties that we like about franchising is that you, as a franchisor, train a franchisee. You train them to be the best at what they do in the sector that they have chosen to work in, and they train them to follow your model. So we don't particularly want a plumber to come into a plumbing business because they think they know better than everybody else sometimes, and therefore might not follow the model better the way that they should. So sometimes somebody having no experience but with the right skills, i.e. managerial skills, processing skills, maybe military background where they've followed processes, those kind of things are really valuable to us. So when you think about putting your CV together and put that in your business plan, it's about what transferable skills do you have to make you a really good plumbing business operator, or pizza operator, or coffee shop operator. Is there enough money? Now, most people think this is all about the franchisee, and we talk about this when we talk about the shows. When you're looking at a franchise, they're asking you about whether you've got enough money. You should be asking them whether they've got enough money to deliver what they're promising to you as well, because you'll be surprised at how many of them don't. So there are some weaker franchise networks out there that don't have the funds to be able to support them because they're new starts themselves. What is the impact if their business is shut, the franchisee shut? What impact have they got enough money coming into their business to cover your marketing schemes if their MSF, the management service fees, reduce? So it's really important that you challenge a franchisor as well, because you want to know that if they're promising to take you to a week's residential training course, that they can afford to do it and they've got the funds to do it, and then that they've got the team to able to deliver what they're saying on. Does the franchisee have enough money? We must not be undercapitalized. This is more and more prevalent now than it ever has been. The ratios that we've got down there below are the different gearing ratios. Many of the lenders have changed their ratios of what they're prepared to lend. So those ratios are 50-50. So in that scenario, if it was £100,000 requirement to set it up, you would have to have a franchisee with £50,000 worth of cash. Obviously, if you've only got £30,000 worth of cash, you wouldn't be able to buy into that franchise necessarily. But you could buy into the one at 70-30 because of the ratio, because it's a more proven model. So therefore, you have to talk as a franchisee, you have to look at what options are available to you. Now, each lender has different ratios. So NatWest might have a 70-30 ratio and Lloyd's might have a 60-40 because they've got different experiences or different opinions on those brands. That's why I said at the start, don't always panic if you get a decline from one person. There are other options available to you. My team, as I said, know what those ratios are, know what the brands are, and we can then help you out looking at those options for you. But they do change. So what is the safety net? Well, you've obviously got the contingency plan, your rainy day fund. So we're going to look at what that is as a franchisee. But what's the security for a lender? So again, wanted to give you a little bit of an overview of how our lenders sometimes look at things. Now, I've kind of over dramatized this because sometimes it does get better than this, but just to remember, we're pessimists, right? So as a lender, you're pessimistic. So you've got a house worth 200 grand with a mortgage worth of 100,000. So you've got 100,000 pounds worth of equity. Now that's brilliant. You've got 100,000 pounds worth of equity in your house. Unfortunately, as a lender, we don't always see it that way because we are looking as a worst case scenario. So we're only going to really call on that as if we're trying to encourage a sale of your property. Now, if we need to get the sale of a property done quickly, typically they would look to sell it at a reduced value. So therefore, they take 70%. It does sometimes go higher, but it's just for, to explain here that just because you feel you've got £100,000 worth of equity in your house doesn't mean that somebody's then going to go, we'll lend you £100,000 on the basis that you've got £100,000 worth of equity in your house. So in that scenario, the security value may only be treated as £40,000. So therefore, we're going to be looking at what else you've got, what credit cards, debts have you got versus what cash have you got, those kind of scenarios. Now, for those of you that have been looking at our industry over the last couple of years, I wanted to just cover off a couple of things that people still talk about, even though they're not available. So the Enterprise Finance Guarantee Scheme was around 2 years ago, pre-COVID. This was a great product to help people that didn't have security to put up, so a house to put up for security. They would be charged a premium for the loan, and they would pay, say, for example, 2% additional charges to cover the fact that the government would back the lender's loan. So we would, as a lender, be covered for 75% of the guarantee. Unfortunately, when COVID happened, that got suspended and hasn't come back yet. It was a great product. So anybody at the old school, or some old franchisees, for example, that are looking to come back into it, may be asking about this. So it's important that you know what it is. That was then replaced by the Coronavirus Business Interruption Loan Scheme. Another great product to help people get onto the ladder and keep us lending. Worked reasonably well, to be fair, and that covers us for 80% of the loan or asset finance. We can utilize that on other products as well, but again, it depends on each different lender, have different criteria. So that has expired now, so that's all gone. So that's completely finished, but we now have the next scheme, which is the Recovery Loan Scheme. So this is a product that we are able to use, and again, we're an approved lender, and some of our banking partners are approved lenders on here, but also some of our asset finance companies and mezzanine debt companies are as well. It's backed by the British Business Bank. It helps us get lending, and it gives us a guarantee of up to 80% of any eligible loan, asset finance, invoice finance, or overdraft facility. Now, each lender has different criteria for what they're prepared to do and may not offer all of those services. But again, our team knows that. So give us a call because we can save you a load of time. But you can see what it does there. It can give you facilities up to 10 million. It means you don't have to put personal guarantees up for something less than £250,000. Expect to put personal guarantees up if you're going over that. And if you're not using the Recovery Loan Scheme and it's a new start business, you need to expect to be providing personal guarantees. We need to see that you're prepared to stand behind your own business. This product's available up until the 31st of December. We don't know what will happen after that, but they've changed them on every time we've got close to those guys. Normally, they give us a little bit of time to run off, so as long as your credit approval is done by that time. But up until we know that, we don't know. So again, you may get a credit approval now based on an RLS deal. But if you're maybe opening something that's going to be a new site that's going to take 6 months, you may miss the cutoff for this. So you may not have your approval for that product in January. So you may be a little bit in the lap of the gods. But again, it's about, we'll talk to your team about that and what's the way to do it. It's available for new start businesses, depending on which lender you go to. So some can do it and some can't do it. The important bit here is to be accepted. You're going to have a really comprehensive business plan demonstrating the financial viability and the ability to repay the debt that you've got coming into your business. So what I wanted to do now is just to give you a little bit of an overview of some of the debt that we've got, some of the business plans process to cover the debt that you've got as well. So what do you need to do? What are we going to want to see? So we're going to want to look at a comprehensive business plan that must include all of your personal financial details for any of the directors of that business. Or shareholders of the business, and it must have detailed financial projections. You cannot come and ask for money without these things. You just won't get the lending, and if you do get the lending, you should be very worried about the lending source, because the chances are it's going to be at extortionate rates. I don't understand why a person wouldn't want a business plan to show what they're going to do, because it's much better to work this out on paper and make sure it's going to work for you on paper than it is to work out after you've spent your paper, i.e. your money, and found out that it doesn't quite deliver what you expect it to. So very quickly, a business plan needs to include a very brief executive summary, what the business is, why it's going to work, what you want, and an overview of it. So very quickly, I'm understanding why I want to lend you some money. I like the business, I like you, I like the concept. Yeah, I'm all warm and fluffy before I've looked at anything else in the business plan. An explanation of what the franchise does, because obviously don't forget our credit guys may have never heard of it. A description about the market and what your USP is and how you're going to compete. So if you're opening a coffee shop and you've got a coffee shop next door to you on either side, why are they going to come into yours? What are you going to do different? Is it the environment? Is it the cost? Is it the fact that you're going to do food? Those kind of things. What makes you different? You can't just build a business plan based around, well, I know that they sell 500 cups of coffee a day. They sell 500 cups of coffee a day. So I'm going to get a third of the business on the street. Therefore, we're going to sell 300 cups of coffee a day each. You need to have some strategy behind it. What are the market proposals and how are your business objectives going to work? What type of borrowing do you think you're going to need? Is it a loan? Is it asset finance? Is there equipment in your franchise? Is it vans? Or is it a management type franchise? Something like an action coach where it's about working capital to cover you for the time that you're building your business. We've covered off your personal finances and your CV, but again, make sure you build in those transferable skills. And the security that is available is important to us as lenders, i.e., do you have any? When we look at your car, do you own it? When we look at your house, how much do you own? Whether you've got shares, whether you've got a pension, all of these things are important to us. When can you draw on your pension? It should also include a SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats. So you've got your strengths and weaknesses, which are current, today. Your opportunities or threats are things in the future. It's really important that you think about those and you write them down. You'll be amazed at how many business plans we see that have got one or two strengths and lots of weaknesses and threats. If that's the case, please go back to the drawing board before you invest money, because is that something you really want to invest in? Because we probably aren't going to feel particularly comfortable about it. And then obviously we covered off your Brexit and your COVID statement. So the key thing to remember is that businesses go bust when they run out of money, okay? And cash is king, but profit and cash are not the same thing. You'll be amazed at how many people look at their businesses and go, I've invoiced that, so therefore it's profit. We made a load of money, but you haven't made a penny until they pay the cash into your business. So those financial projections are vital, and they should be sensitized to show what could happen. So look at your worst case scenario, look at your best case scenario, look at your expected scenarios. Also look at those break-even scenarios. So financial projections form a key part of that business plan. So these might look boring, but they're hugely important to everybody. So we do 3 years of these in all of our business plans to make sure that we can really see it. The cash flow is critical. We really want to make sure that you guys have enough cash to cover it and you've got that rainy day fund. So in our business plan, you'll see a graph that goes like this, which shows your worst case scenario. And then we want to make sure that you have a certain amount of money left at that point. So what do these three things show? Well, your profit and loss account should show your sales less trading costs, and it will either deliver a profit or loss. Don't panic if it delivers a loss, if that's what the model, the franchisor says should happen, because us as lenders will have seen those models from other franchisees. You'll be amazed at how many people try to change it so they get to a profit, and then you go, hang on, we don't normally make a profit on these until 18 months. So don't panic if it doesn't make the profit, as long as that's in line with what everybody else is doing. Obviously, as a lender, we're going to need the data to support that, which is why we need to work with the franchisors to get that data. Your mirror image of your bank account is what your cash flow forecast should look like. So this is what your bank account says every day. Not I've invoiced it. It's how much cash have I got in it and how much am I going to have to pay out in the next day or two. And the list of your business assets versus your liabilities is the balance sheet. But in layman terms, the profit and loss shows what you hope to do and what you hope to achieve from it. So I'm giving up being a teaching assistant or a teacher, and I want to deliver this. Is it going to be worth my while? Is it a lifestyle change or is it a financial change? How much money you need and can you afford to do it? And the balance sheet is going to show at the end of each period what you owe versus what you own. So we go back to, what are our end goals? Do we want to be able to generate a business that we can sell, or do we want to generate a business that can deliver us a profit that's going to enable us to take drawings out of the business to cover my cost of children's going to university? So those financial projections, you must ensure you ask for enough working capital. It's easier to ask for some extra cash at the start based on franchising, because obviously it's a proven model, than it is to sometimes go back and ask for something after the event. So if you're 3 months in and it's not quite going to plan and you come and ask for some more money, that could be harder than if you asked for a little bit extra at the outset to make sure you had a buffer. Now, we're not asking people to over borrow. And the important thing about that is to understand the product that you're borrowing it against. So certain products you can return the cash early. Others you can't. You'll be penalized if you settle the contract early. So there might be a settlement charge. It's really important that your franchisees work with somebody that understands that. And that's why us at Hitachi like the fact that we have the panel of lenders, because we can work with a bank that might have the right product for 50% of the lending, and we can work with our own funds for the other 50%. It gives us the ability to mix and match. If you work with one lender, that lender will only sell you that lender's products, whether it's the best product or the best price or the best process for your franchisee, because that's all they can sell. So it's really important that you look around at what the options are. Like I say, my team know those options, and we can feed that back to you, and then we work closely with the banks and the other lenders to make sure that we get the right product for you. Consider capital repayment holidays. So for example, in the care industry, quite often there might be a capital repayment for the first 12 months, because obviously it takes time to establish the business. Not always the case, because it depends on the security, but that could also look for your capital repayment holidays on things like leases. If you've got a premises based, ask. You don't get if you don't ask. And also make sure that you build that into your business plan to know how and when you're going to have to start repaying the debts that you've accumulated. And it must show what you're going to do in the what if scenario. So we talked about the worst case scenario, the best case scenario. What happens if there are rising costs? What happens if interest rates go up by 2%? Interest rates are very low at the moment. Base rate is incredibly low. Is it right to take a fixed rate loan? Could be. Is it right to take a variable rate loan? Could be. What happens if it goes up? Now, most people think about this purely about my cost of my debt is going to go up because my interest rate's gone up by 2%. When we're running a business, what happens if our customers have a variable rate mortgage and the cost of their variable rate mortgage goes up because the interest rate has gone up by 2%? If our product is a lifestyle product and something that's a nice to have, that might limit who can afford our product. So actually there could be an impact in your turnover as well. So it's not just about thinking about your debt, it's about thinking about who your customer base is and what could happen to them. So we all need a plumber. So somebody's still going to pay for a plumber when they need a plumber. However, if it's a gym membership or a coffee shop, that could be more of a challenge, because that might be something that, or massages, they might be something that they stop paying for because they've got to pay for their increased mortgage costs. So you need to think about where your product sits in the marketplace. What happens if there's another lockdown? How long could we cover our expenses for? What happens if there is no furlough at that point? And are our loan repayments going to be covered? As lenders, we're typically looking for at least 1.5 times debt service cover. So we want to make sure that you're making enough money 1.5 times at the debt that we need you to pay back every time. Each lender has a different criteria, and you may see them put certain covenants into your deals. So that's a very whistle-stop tour of what you can do and how you can go about getting the funding and how we can help. We're here to help, as are the other lenders in the arena. But we talked about training. My team we've got a team of trainers as well. These are the kind of things that we can help you out with. So if your franchise network needs some support, please get in touch and come to us via Julie, if that's the best way to do it as well, or Nick. But in conclusion, the aim of today was really to talk about lending and the fear of debt. So go back to my story at the start, where I had never borrowed money. My family had never borrowed money. They would have freaked if I said I was going to go and borrow 3 million quid to buy some cars. But because we'd worked it all out, we had a well-presented business plan. We'd thought about the risks through our SWOT analysis. We understood where our income was going to come from, and we mitigated all of those risks. We had nothing to fear. We did the right thing. We had nothing to fear, and we made a very successful business on the back of it. Lenders are still lending. Funders are still funding, but you have to come to us with a well thought out, well presented business plan and proposition, and you have to be prepared to provide those financial details and the data to support it if you're a franchisor behind the scenes. Otherwise, it will be much, much harder. The harder it gets for your franchisees, the worse the rate goes, because they tend to go to tier 2 and tier 3 lending people. That's when it puts a risk on your franchisee and it puts a risk on your brand. So the important thing from our side as a lender and a reputable lender is to make sure that you look at what the options are and make sure you work with your franchisees to think about what those options are. I'm not saying it's the wrong thing to do to pay some of those higher rates. It may well be if your business plan can sustain it, but it does increase the risk. And if somebody is having to pay those rates, there's usually a reason why they're having to pay those rates, and that can have an impact on your brand. So overall, that's a very quick overview of us. By all means, mail me any questions. I'm quite happy for Julie and the team to send the presentation out to people. By all means, take that and keep in touch with us. But really, that's the end of the presentation. So it's back over to, does anybody have any questions that they'd like to ask of me or my team? So David's on here, so there are some questions by the looks of it. So
no problem. Can I first of all say thank you for that, Paul? Very, very detailed but insightful, and sort of it gave us a real insight into the attitude to debt, didn't it, really, and the attitude to borrowing. Can I start a question off first, simply because I think what happens is, people sit there and say, maybe we're not going to ask a question, or maybe we will. And what I'd like to do is ask a question about whether or not the pandemic has made lenders more risk averse overall, or is it now coming through the back of that? Is there a state of play where we're getting back to some pre-COVID normality?
I think it's a combination of both, actually, Nick. Is it back to where it was before? No. But has the government schemes helped? Yes. So again, it goes back to looking at the right product for the right customer. And our lending criteria hasn't changed. Yeah, we're still lending to the same companies, the same customers, new startups. What we're doing is making sure that maybe our due diligence has got more in depth. So as a franchisor, you should be prepared to make sure that we're going to want to ask more questions. We know that there has been a lot of people that haven't been able to afford to pay their bills. So certain sectors have been hit harder than others. So lenders will have changed their lending stances potentially in those sectors. But again, it goes back to, if it's a good proposition where we believe in the opportunity, we believe in the franchisee or the customer, and it's presented properly, there is the ability to lend there. You just have to make sure it's pitched right. The challenges are coming around the fact that there's still more people just coming off furlough. What's going to happen to sectors now? So we're just more, I wouldn't say we're conservative. I just think we're more nosy now. We want to know more about it before we lend it. So it takes a little bit longer potentially sometimes, but we've still got deals going through. I've just got a deal, just got in here today. It's gone into credit. It's been turned around in less than 15 minutes. Because the information that's been provided was there to turn around and say, this is a safe deal, get it done. So the lending opportunities are still there, and we're actually lending more money now than we were pre-pandemic.
Okay, thank you. Vicky, I believe you got a question. Do you want to unmute for me, Vicky? Yeah.
Yeah, it was sort of along the same lines in terms of franchisors. Companies that have been through a tough time, their balance sheets aren't going to look so good. What potential effect would that have?
Yeah, I mean, it goes back to what we were saying, Vicky, at the start, that the strength of the franchisor is important. We need to understand how and why your balance sheet's been affected. Is it because you hadn't received management service fee income? Is it because you couldn't get grants? And then what are you doing to bolster that position? So the balance sheet is still important to us as lenders. We also need to understand what you're putting back into the business and how you're going to trade out of it as well. And that goes back to you having a business plan. It's not just about having a business plan as a startup. It's about redressing your business plan all the way through on your journey. But yeah, if your balance sheet has taken an impact, we're expecting certain sectors to have lost money over the last 12 months. But what we want to see is it back to where it was? Yeah. So what were you doing in 2019 and 18? Is it back to where it was? What are you doing to make sure that you don't get yourselves into that position again? I go back to my statement about many people only had 3 months worth of working capital. What measures have you taken, and have you made your business stronger going forward?
Okay, thank you.
Thank you for that. Mark Scott, and then Chris from Poppies, please. Mark.
Yeah, thanks, Nick. Paul, first of all, I'd like to say, as an ex-banker, I thought that was a brilliant presentation. I've heard many over the years. Normally mine are better, but I can't say that in this.
I've watched all of yours, Mark, so that's where I got it from.
No, that was really good. Really enjoyed that. There's just maybe a point and a question, maybe, because I've been out since April, so I'm not quite so up to date as I should be.
Yeah.
But there's a couple of things that I thought of that might come out when you're doing a SWOT analysis. It is the sort of things that are happening in the wider world in terms, I know you mentioned COVID, but what about the move from maybe petrol to electric? What are the Shell garage franchisees? What's the view on things like that? And also, sort of related, if prices for householders are going up as an individual, are you looking at what increased costs may go into their personal expenditure as well? Thanks.
Absolutely. Yeah, so both really good points, Mark. So thanks for raising those. Yeah, I mean, obviously we're looking at the time frame of what we're doing over a lending period. So if you're looking to lend for something for 3 years, then typically we're looking at what impact your business would have in that time frame. If you're looking over a longer period, then definitely we're going to be looking at what's going to come down the market. Now, from Hitachi's perspective, we're very focused on things like the green energy, moving to electric vehicles, and there are obviously differences in costs for those. So we're looking at expecting a franchisee or a franchisor, if they're supporting, to turn around and say, you know, if we're a delivery vehicle, we're looking to take all of our vehicles to electric by 2027 or whatever the date might be for them. What's the impact? How does that build in? What's the study that's been done? And what's the cash flow that's required? So absolutely looking at those kind of things. And they can be a negative and a positive, because it might cost more money, but actually it might bring in more business to you because you're becoming more environmentally friendly and sustainable, which is what attracts more customers. So it's what that business case looks like. As part of any business plan, you'll be asked, or any application, you'll be asked to do what's called an affordability. So we look at your assets versus liability, and then we look at really what your lifestyle is. So in that lifestyle, we will look to see what your income is and what your expenditure and outgoings are, and that will include everything from your clothing and Sky TV to your fooding and gas and electric. If we're expecting to see those things increase and there's very tight margins in terms of your income versus your expenditure, then we will start to say, what are you going to do if, and what is your contingency plan? And their contingency plan might be that I pay £100 a month to Sky TV. I can live without it. I'd have some unhappy children, but at least I can afford to pay my bills. So yes, those things are definitely in there, Mark, and each lender has different stances on those.
Thanks, Paul. Thanks.
Thank you. Conscious of time, but Chris, you got a question?
Yeah. Hi, Paul. Thanks for your presentation so far. And I think you've just started to touch on the question of working capital and how that relates to a new franchisee's desire to take drawings from a business when it's not yet making profit.
Yeah.
So I think there's a general recognition that people need an income.
Yeah.
But how does that affect your lending decisions? You know, are you expecting a franchisee to, you know, who lived on 50,000 to now be able to live on half of that because they're starting a new business? Does that affect the ratios that the bank's prepared to lend at, or the lenders are prepared to lend at, etc.? How does all this fit together?
Yeah, each lender has a different stance on it. As you imagine, if somebody comes into something and they've been earning 100 grand a year, they might be looking to do a change of lifestyle. So the lifestyle is, do you need 100 grand a year? What do you need to live on, and what do you need to understand? Now, that's fine, and lenders do look at that in an individual way. But if, for example, I just use one as we've had as an example recently, if you're looking to borrow, let's say £60,000, and when we look at your lifestyle and expenditure, half of that money is to cover the fact that you want to send kids to private school and it's very expensive, etc., etc. Actually, all we're doing is not funding your working capital, is we're funding your lifestyle. And that's where people look at it in a different way. So it depends on how much you're looking to draw. As a lender, we know you're going to need to draw funds to live, but how much you're prepared to put in also affects that. So don't expect the lender to really want to lend you £60,000 to draw £60,000 over the first 2 years in drawings if it's going to take us 5 years to get our lending back. There has to be a balance, and each lender has a different view. We would expect your lifestyle, look at your lifestyle and challenge your lifestyle, and we look at your bank statements as well to make sure that we believe the lifestyle as well, because it's important to understand that they are reflective. But we know you need to get a drawings, we know you need to have a living, but that's somewhere where your rainy day fund and your contribution comes in as well. So it's a combination of everything, Chris.
Right. Okay. Thank you.
I'm conscious of time. One more question from anybody before we go wrap through, and I'm going to share Paul's full contact details. Anyone got a raised hand or a question or anything else? Okay, so, well, first of all, again, thank you very much for your presentation on the on the session, Paul. We've put your contact details on the slide deck there. We've got your direct dial, your mobile, obviously your email address as well. I'm sure that people can talk to us at the franchise company, and we work with you closely to make sure that we're all on the same page. That was really, really interesting. And, you know, as one of your colleagues from the industry said, as good as it gets from a banking perspective. So congratulations and thanks for that. Our next event is the first Friday, and it is indeed the first Friday of November. And next month, we're taking a completely different look. We're looking at the power of PR. Now, we've got Lucy Archer from Rev PR, and what we'd like you to think about is PR is not the exclusive right of organisations who do the soft and fluffy. She's going to look at really powerful ways of impacting your business by promoting successes and using PR for the positivity that it can create for you. So it's not for those who are not doing it, it's not for you. If those are already doing it, some tips on maybe how to improve and develop things. One not to miss, Lucy Archer, Friday 5th of November, and a date for your diary. The last one of the year will be Friday the 3rd of December. It's fair to say that John Pratt from Hamilton Pratt is an absolute titan of the franchise sector, and he's going to be talking about the legal perspectives of franchise management, you know, getting things right, protecting you, protecting your franchisees, and making sure that the business is built on solid legal foundations. So that's all that remains really, is to say, hopefully see you in November. It's been great to have you on as our guest speaker, Paul, and thank you again for that. All of you are, you know, we really appreciate the support you give us the first Friday, and would love to see you again at future ones. Amy is next week going to be sending you out the contact details for booking on for the November sessions. But in the meantime, I'd just like to say thank you for attending. Have a great end to the week. Hope the sun's shining somewhere near you, and we'll catch up with you in November. Thank you very much. And
thanks, everybody.
presentation.
Yeah.
Thank you.
Bye.